In the high-stakes world of cryptocurrency, two mantras echo louder than any other: HODL and DCA. One is a battle cry for long-term belief, a defiant stand against market volatility. The other is a disciplined, almost meditative practice of steady accumulation. For years, investors have treated them as separate paths. But what if the greatest strength lies not in choosing one over the other, but in weaving them together? What if the secret to conquering the chaotic crypto market isn't just holding on for dear life, but doing so with a calculated, intelligent plan? This is the story of how two of the most powerful strategies in finance become an unstoppable force when they unite. The concepts of dollar cost averaging DCA and holding on for dear life HODL are often discussed in separate corners of the investment world. HODL is the philosophy, the unwavering faith in an asset's long-term future. DCA is the method, the systematic process of buying. They are not rivals fighting for supremacy in your portfolio. They are, in fact, perfect companions, designed to navigate the turbulent seas of the digital asset market together. By integrating the disciplined rhythm of DCA into the marathon mindset of HODL, you build more than just a position. You build a fortress against psychological risk, a machine for optimizing your average cost, and a testament to your long-term conviction. This combination transforms passive holding into an active, intelligent accumulation strategy, turning market chaos into your greatest ally. So, how does this powerful partnership actually function? Think of it as a strategic alliance. The ultimate objective of a HODL strategy is to capture the long-term upward trajectory of the market, holding through the dizzying peaks and terrifying troughs to realize significant growth over years or even decades. The objective of DCA, on the other hand, is purely mathematical, to smooth out your entry points and lower your average purchase price over time. When you merge them, DCA becomes the engine that powers the HODL vehicle. It's the systematic execution that allows you to HODL smarter, with less stress and greater efficiency. It's no longer just about holding. It's about how you build the position you intend to hold. One of the greatest demons that haunts every investor is the pressure of timing the market. The pure HODL strategy, while noble in its intention, has a critical vulnerability right at the start. Imagine you've just come into a significant amount of capital and your conviction in Bitcoin is absolute. You decide to go all-in, buying your entire position at once. But what if your timing is tragically unlucky? What if you buy at the absolute peak of a bull run, just before a massive gut-wrenching correction? As the price plummets 50, 60, or even 70%, your belief in HODL will be tested by fire. Every day, you'll be staring at a sea of red, fighting the primal urge to cut your losses and run. This immense psychological pressure is where most novice hodlers break. This is precisely the problem DCA was born to solve. Instead of deploying your entire capital in one risky move, you commit to a different kind of discipline. You divide that sum into smaller, equal portions and invest them at regular, predetermined intervals, say, every Friday morning or the first of every month. You do this regardless of the price. Whether the market is euphoric and hitting all-time highs or steeped in fear and despair, your buying action remains the same. This automated consistency liberates you from the impossible task of catching the bottom or predicting the top. You're no longer a market timer. You're a market participant, steadily accumulating through all seasons. The crippling anxiety of making the perfect entry vanishes, replaced by the calm assurance of a long-term plan in motion. The true mathematical genius of this combined strategy reveals itself in the concept of averaging down. This is where market downturns, the very events that terrorize most investors, become your opportunity. When prices fall, your fixed dollar amount, let's say $100 per week, automatically buys you more units of the asset. If Bitcoin is $50,000, your $100 gets you 0.002 BTC. If it crashes to $25,000, that same $100 now buys you 0.004 BTC. You are acquiring more of the asset precisely when it is on sale. This systematically lowers the average cost of all the coins in your portfolio. Conversely, when prices are high and climbing, your fixed investment buys you fewer units. This naturally prevents you from over-investing at potentially inflated prices. Now zoom out and adopt the HODL mindset, looking at your portfolio not over days or weeks, but over many years. What you will see is a powerful result. Your average purchase price will be a smooth, blended cost that is significantly more favorable than if you had tried to time the market with a single lump sum purchase. You will have captured the benefit of the dips without having to predict them, and you will have participated in the run-ups without getting carried away by FOMO. This blended average cost means your portfolio turns profitable much sooner and becomes more resilient during inevitable market corrections. DCA ensures that the foundation of your long-term hold is built on a solid, cost-effective base. Beyond the numbers, the fusion of DCA and HODL instills a critical and often overlooked element: long-term investing discipline. A pure HODL strategy can sometimes feel passive, almost neglectful. You buy, and then you try to forget. But in the depths of a brutal bear market, when headlines scream of crypto's demise, forgetting is impossible. The temptation to panic sell becomes immense. DCA transforms as HODLing from a passive hope into an active, disciplined habit. It provides you with a recurring, positive action to take, a ritual that reinforces your long-term thesis. Sticking to your weekly or monthly buying schedule becomes an act of defiance against market fear. It's a way of telling yourself and the market that you believe in the future, and you are using this period of weakness to strengthen your position. This disciplined consistency is what separates the weak hands, who are shaken out, from the true long-term believers who emerge from the crypto winter stronger than ever. So how do you put this powerful strategy into practice in the volatile crypto arena? Experts recommend a clear 4-step process to seamlessly integrate DCA into your HODL philosophy. First and most critically is choosing your assets. The HODL strategy is only as strong as the asset you are holding. It is utterly ineffective if applied to a project with weak fundamentals, fleeting hype, or no real-world utility. Your focus must be on blue-chip assets that have demonstrated long-term resilience and have a strong potential for sustainable growth. We're talking about the pillars of the industry like Bitcoin and Ethereum. These are assets with proven network effects, robust security, and a clear vision for the future. The role of this step within your HODL framework is paramount. It ensures that what you are holding is actually worth holding for the long haul. The second step is to determine your capital and your cycle. This is where you define the rules of your own game. Decide on a fixed amount of capital you will invest at each interval, for instance, $50, $100, or $200. Crucially, this must be an amount you are genuinely willing to lose. Money that will not affect your ability to pay bills or handle emergencies. Next, establish your purchase frequency. Will you buy weekly, bi-weekly, or monthly? A more frequent cycle, like weekly, can smooth your average cost more effectively, but a monthly cycle is perfectly fine if it aligns better with your income schedule. The purpose of this step is to establish the discipline and financial sustainability required for a long-term investment horizon. It makes your HODL journey affordable and repeatable. Step 3 is to make your recurring buys automatic. The goal here is to remove emotion and human error from the equation entirely. Nearly every major cryptocurrency exchange offers a recurring buy or auto-invest feature. Use it. Set up a recurring purchase for your chosen asset, with your chosen amount, on your chosen schedule. Once set, the process becomes completely automated. On the designated day, the exchange will execute the purchase for you, whether the price is soaring or crashing. This is the heart of the strategy's power. It guarantees you will continue to accumulate through the entire market cycle, taking the emotion, the second-guessing, and the temptation to tinker completely out of your hands. Finally, the fourth step is to monitor and evaluate, but from a HODLer's perspective. This doesn't mean checking the price every 5 minutes. It means periodically, perhaps every 6 months or once a year, reviewing your progress. Just look at the total amount of the asset you have accumulated and calculate your average purchase price. This provides positive reinforcement and allows you to see the strategy working over time. This is also the time to make minor adjustments. If you've had a salary increase, you might decide to increase your DCA amount. However, you should strive to maintain the consistency of your purchase cycle. The role of this step is to evaluate the efficiency of your accumulation plan without getting distracted or swayed by the daily noise and short-term price fluctuations of the market. In the final analysis, the combination of dollar cost averaging and HODling represents one of the most robust, accessible, and psychologically sound risk management strategies available to the modern investor. It is particularly powerful for those new to the crypto space, or for busy professionals who lack the time to perform constant market analysis. By automating the buying process, it systematically removes the two biggest enemies of investment success: fear and greed. This isn't just a way to HODL. It is a profoundly wise approach to HODling. It transforms the act of long-term asset accumulation from an emotional, high-stakes gamble into a controlled, disciplined, and repeatable habit. If you possess a genuine, long-term conviction in the future of a digital asset, then using DCA is unequivocally the most effective and least stressful method for building your position and turning that belief into a tangible financial reality. You are not just holding on, you are building, block by block, a stronger foundation for your future.